I get asked a lot about extra payments and what does it take to significantly impact your mortgage and make it to where you pay less interest. So I wanted to go over that in a little bit of detail. Hopefully this will be good information for you. What I've done is I used $100,000 as the mortgage amount. That's an easy number to, if you need to double it for your scenario or cut it in half, whatever you need to do, this will hopefully be an easy way to put it in perspective for your own situation. So with a $100,000 mortgage amount, I used 4.25% for interest, just again for a ballpark, and I did a 30-year loan. So kind of where the magic starts to happen in the sweet spot is if you can make one extra payment on your mortgage per year. And one payment being your principal and interest portion of the payment. It doesn't have to be your taxes and insurance that you include in this. So if you just take your house and divide that monthly payment into 12, you take and add that to your mortgage. So in this example, the monthly payment on a $100,000 loan over 30 years at 4.25% interest is $492 a month. So we'll divide that $492 by 12 and we get $41. So instead of making a $492 house payment, we're now going to make a $533 house payment. So if you do that $533 every month for the life of the loan, it significantly impacts what you're going to pay in interest over the life of the loan to the tune of about $25,000. So $25,092 is exactly what you would save over the life of your loan if you could just make that one extra payment per year. So the other way to put that in perspective too is that when you are paying your mortgage payment, you are paying more interest than principal in the very beginning, because that's when your loan, the amount that you owe is the biggest. So you're paying significantly more interest than principal at the beginning. And it stays that way. But over time, it starts to kind of close the gap. Your principal and your interest payments start to get closer and closer together. And then at one point, it flip-flops. And all of a sudden, you're paying more to principal than you are to interest. And that, again, is kind of another sweet spot. So when you're paying your minimum amount due and you're paying nothing extra, the point where that hits and then all of a sudden you're paying more principal and interest is month 303. Now there's 360 months in a 30-year loan. So it's not until month 303 that you're actually paying more to the principal than the interest. However, if you can make that extra $41 a month contribution to your payment, by month 214, you will hit that sweet spot and start to pay more principal than interest. The other thing that it's going to do too is obviously it's going to speed up how fast you pay your loan off. So if all you do is pay the minimum amount due, you're going to have your mortgage paid off in 360 months. If you can make that one extra payment a year, you'll pay it off in 309 months. So clearly that's going to save you, a significant amount of months on your loan, years, literally. So hopefully this is enough detail that it kind of brings to light some of why there's that a lot of, encouragement to make that extra payment of a year if you can do that. And obviously if you can throw your full payment, the one that includes taxes and insurance, divide that by 12 and add it, and make your monthly payment a little bit bigger yet, and that's just going to, expedite all that. It'll make your month pay off faster, make your interest and principal flip sooner. So hopefully this is good information. If you have any questions, you can always reach out. My website and phone number at the bottom, and I'd be happy to help you. Have a great day.